The Smith Maneuver allows you to make interest on your mortgage tax deductible, but not many people know about it. Joining me now is Ed Rempel, a fee-for-service financial planner and tax accountant with some ideas on how to optimize the Smith Maneuver. Ed, thank you for joining me this year.
Great to be here, Barry.
Now, before you get into your presentation, I know a lot of people have heard about the Smith Maneuver and they don't know about it. Can you briefly explain what it is exactly?
Yeah, okay. So, very briefly, you just get a readvanceable mortgage as a mortgage linked with a credit line. And as you're paying down your mortgage, you automatically get credit in the credit line and you use that to be able to invest. Okay. And so the way to think of it is as part of your retirement plan. That's the most effective way. So I call it's like it's an efficient strategy to use your home equity to invest for your retirement without using your cash flow. There's a kind of a efficient way to do it for that. And it's a quirky sounding name, but we've done lots of retirement plans for people, and we find lots of people just they're not able to save enough. Like, life is expensive, they're not able to save enough for retirement, and this is a way that you can get a whole additional portfolio that doesn't use your cash flow, so you can still do all your RSP and TFSA and everything else you're doing. And it's an extra amount. And we found a lot of times it really makes a difference, to be able to have the retirement that you want.
Okay. Fantastic. I'm looking forward to this presentation. Let's take it away.
7 best ideas to optimize the Smith Maneuver. Now, the Smith Maneuver, it's kind of a quirky name. I'm usually not much into, strategies with quirky names and stuff, but this one actually really works. We've done this. We've done, well over 1,000 financial plans, comprehensive, and there's a fair number of them that have the Smith Maneuver in it. And it's just from experience, we just found that this works really well. So it can be highly effective when done by the right people in the right way over the long term. Now, so many Canadians, just find it hard to save enough for retirement now, especially with inflation being so high. And, what the Smith Manoeuvre does is it helps you build that nest egg to make your retirement work. So basically, just what it is, in short, it's an efficient strategy to use your home equity to invest for your retirement without using your cash flow. Okay, it also converts your mortgage to a tax-deductible credit line over time, is what it is. Okay, now I'm going to assume in here that you know kind of the basics. If not, probably the best description of it on the internet is a blog that I have on my blog. So if you're not sure all the details, read that. You'll know everything all about it. So, but what we're going to talk about here is how to optimize it, the 7 best ways. So what we're going to talk about is, what is the right reason to do the Smith Maneuver? How do you know if you're the right person? What is the right mortgage? How can you keep it 100% tax deductible? Which of the 8 Smith Maneuver strategies is right for you? Why is it critical that it is a long-term strategy? And what's the right mindset to minimize the risk and maximize the benefits? All right, so the right reason to do the Smith Maneuver. So first of all, it's not tax deductions. Okay, so when we calculate the benefits or estimate, usually the tax savings are about 15 or 20% of the benefit. So most of it is building up your investments, and that's most of the benefit. So it's not getting rid of debt, because you're replacing the debt. So you're not actually getting rid of it. So it's the right reason is to invest for your future without using your cash flow. Yes, you get tax deductions. And, if you invest tax efficiently, most of our clients are getting refunds most years, even after they retire and they're taking income. So, and it can help you pay off your mortgage faster if you use your refunds to pay down on the mortgage. So, but, I've had people come to me and say, I want to do Smith Manoeuvre in order to get rid of my mortgage. And I said, well, you know what? If you're really debt averse, this is not the right strategy, because we're borrowing to invest, right? So we're replacing it. So you can use it to make the mortgage tax deductible, but it doesn't get rid of it. So that would be the wrong way to do it. So, long-term, the benefits could just really be significant, and they add up. So typically when we look at the benefits over 25 years, if you start with just no equity, just 20% down in your home, the benefit over 25 years is typically, roughly the value of your home today. So it's actually quite a lot. And it's an efficient use of the home equity. We had one client who was a widower, had no kids. And he actually said to me, he says, you know what? I don't want to die with a paid off house. He says, to me, that is a lot of fun I didn't have. I don't want to have that all equity I didn't use. So I want to use it in some way. So that's really what it is. It's a way to help you have the future you want, probably for your retirement plan. And that's the right reason. The right reason is that it's part of your retirement plan. So, you see the typical illustrations that show, your mortgage is going down, your credit line is going up at the same rate. And then the investments, but that you're borrowing build up. And the total debt stays the same because as your mortgage goes down, the credit line goes up, the total stays the same. And, meanwhile, your investments build up. So that's the net benefit. It ends up being about 25, around equal to the value of your home after 25 years. So it works out really well over the long term. If you could stick to it and you can just do it really optimally. So now, how do you know you're the right person? So basically, you must have the risk tolerance and be able to stick with it long term. That's really the main thing. So, then risk tolerance, you see these questionnaires, but what is risk tolerance really? Really what it comes down to, it's the ability to do nothing when your investments go down. That's all it is. If even once in the next 20 years you panic and sell after it's gone down, then this is not the right strategy for you. You got to be able to know you can stick with it all the way through. So, yeah, and it's a commitment, we usually suggest to have a minimum of 20 years. Better is do it for life, or, as long as you own your home, you're always going to use this equity, and it's eventually paid off when you sell the home. We had one came to me once and says, you know what, it sounds good. Let me try it for a year and see how it goes. I told him, you know what, don't even start if that's what you're thinking, because who knows what the first year will be. You got to be able to stick with it, or this is not the right thing. So what is the right mortgage? So you need a re-advanceable mortgage. So it's a mortgage that's linked with a credit line. As you pay down the mortgage, you automatically get credit available. Now, I've had people come to me saying, oh, yeah, I got a re-advanceable mortgage. But it turns out all they have is a credit line, not a mortgage. And yeah, credit line re-advances. If you pay it down, you can borrow back. But that's not what this is. We need a re-advanceable mortgage that's linked with a credit line. Now, there's basically at least 10 of them now in Canada, and I've got a blog post about, all of them and the pros and cons and which ones are best. So, but what you're looking for, and actually I rate them all on there as well. What you're looking for is you want to be able to borrow up to 80% of the value of your home from the beginning. There's new OSFI rules that I have a video about that will bring it down over time, but you want to start with 80%. It's nice to be able to invest directly from the credit line. It's a nice plus. You want to have no monthly fee. It should automatically re-advance. So when you make the mortgage payment on the same day, you automatically have room on the credit line that you can use. Okay. And it's nice to be able to automatically capitalize, but almost none of them will do that. Like capitalize means the credit line pays its own interest. Usually the credit line has to get interest from a checking somewhere. So you'd want to be able to have no minimum to re-advance. So as soon as you make a mortgage payment, you pay $500 or $1,000 of principal in your first mortgage payment, you could already borrow that. In some cases, there's a minimum before you can do that. So it's good to have multiple credit lines. And then, so often you want to do some different planning. Maybe you want to use one credit line for something else, like buying a car or renovations. And then later on, you put it into your mortgage, and you can use different credit lines for different reasons. You always want to keep tax deductible ones separate from non-deductible ones. You want to be able to have multiple mortgages is another thing. Okay. And all within one overall mortgage, you've got one limit, and you can have multiple credit lines and mortgages within it, ideally. Okay, and if you can have multiple mortgages, that means you can, what happens is once your credit line gets fairly large, what works for some people is you convert the credit line back into a mortgage. Now, you keep doing it the same thing, but now you've put part of the credit line into a mortgage. It's still deductible because it's money you borrowed to invest. But now you're getting a lower interest rate. Okay, it's more complicated because you're paying down principal, which of course you can reborrow again. But having the option to have multiple mortgages is good down the road. And especially now, once there's a maximum size that a credit line is allowed to be. So you can borrow up to 80% totally in your home, but only 65% in the credit line. So once your mortgage is close to gone, you get to a point where you can't borrow more for the credit line, even though your mortgage isn't gone yet. And that's when it's good to be able to put part of it into the mortgage. So you want to have that option. Of course, you want to have competitive rates. There are some of them that are available through mortgage brokers. They can sometimes help you. Most of the ones are not, but some of them are. And then also it's a question of, can you put it on a rental property? Because, it's possible to do it on rental properties and cottages and other things as well. So in general, it's a good idea to do it with a financial planner that has experience implementing it, not just doing the mortgage. So mortgage brokers have access to a few, and they can get you a mortgage, but they usually don't know how to implement it properly or know all the tax rules. So they're kind of selling you a mortgage is what's happening. But If it's not the optimal one, once they sell you the mortgage, they're gone. And some of them are just really much easier to work with than other one. So how do you keep it 100% tax deductible? So now, to be deductible, you have to borrow to buy investments that have income potential. Now, some people wrongly believe that you have to buy something that pays income, like a dividend stock, but it doesn't have to pay a dividend. In fact, it doesn't ever have to pay a dividend, but it has to be something that could pay a dividend. So, the prospectus does not prevent it from paying income. Okay, for example, Warren Buffett's company has never paid a dividend, but it could, they could do it. So his investing in it would be fine. So that's what the rules are. So basically, most stock market, what we call equity investments most of them are fine. And there is a CRA folio that describes all this. Now, a key thing is you got to keep your deductible and non-deductible separate, whatever there is. So the credit lines, mortgages, checking accounts, investments, whatever it is, you have one group that are all deductible and one that are not, and you never mix them. Okay, always keep them separate. And it's that keeping separate that keeps them all tax deductible. The other thing was what you want to do the interest capitalization right. So what happens is you can use the credit line to pay its own interest. Now, banks won't do it automatically. So they want to take it from a checking account, but you can go back to the credit line and take the exact amount back. But you want to make sure you do the right amount. So do the exact amount or use a checking account that you use only for Smith Manoeuvre, and then you can always just make sure there's always enough in there. But you want to make sure you're not mixing in non-deductible money into this, virtual circle of tax deductible credit line and tax deductible checking. So, you can borrow from the credit line either to invest or to pay the interest on the loan that's used for investment. And if you do that, all of it stays tax deductible. Okay, so now you can invest from a credit line or you can invest from the Smith Manoeuvre checking, whichever works out easier. So, bottom line, the Smith Manoeuvre isn't complex, but it actually is easy to mess it up and take some tracking to be able to do this. And, if CRA ever audits you, and especially when you get big tax deductions, they may do what's called a pre-assessment. You refile your return and they do a pre-assessment where they want you to prove all your data. And if they audit you, they're not sure about your numbers. They entirely rely upon you to provide the numbers. Okay, so if you can't provide the number or it looks like what you've claimed is not all deductible, they don't try to figure out the right amount. They just deny the whole thing. And it's up to you to prove how much of it is deductible. So we have, a reasonable number of clients do it. So we end up every year with doing a few of these pre-assessments. And usually a 60-page submission we have to send into CRA to support all this, including copies of all the state credit line statements. And usually they look over a 2-year period. And so it's a bunch of work. But, if you know what you're doing, you have everything organized, it can all be done. So it's why it's a good idea to do it with a CPA accountant that knows the strategy and someone that's going to represent you with CRA. So they're going to look after making sure that anything happens. If there's a problem, then you can be, worry-free. So which of the 8 Smith Manoeuvre strategies is right for you? Lots of people talk about Smith Manoeuvre. There's 8 strategies. There's lots of different ways you can do this. And there's, all kinds of adaptations. So the first one is the plain Jane, which is the basic one. It's when you start with just 20% down and all you're doing is investing, no lump sum at the beginning. You're just investing monthly or biweekly. So second's called a debt swap. And that's when you have some debt that's not deductible and you have investments that are not borrowed. What you do is you use the investments, pay off the debt, borrow right back, and then buy the investments back. And now you're in exactly the same position, except your debt is now tax deductible. It's also called the Singleton Shuffle. There was a court case by someone named Singleton that did it and proved the tax deductible. Some of us call it the Flintstone flip, but it's a neat strategy. It's because you automatically convert a debt to tax deductible in one day and there's no risk with it. Third one is the top up. This is actually the most common. And usually what happens is when you start the Smith Manoeuvre, you've got some equity now. So if you've got some equity, you can borrow up to the 80% right off the bat and put a lump sum in to start, and that, gets it going faster. Then there's a version called the triple top up. So you take whatever credit is available and you go and get a 3-for-1 investment loan on that number. Okay, now you're starting out with much bigger number. Now you got to make the cash flow all work, so it's a little bit tricky. But there's ways to really enhance this and make it go a lot faster. Fifth one is called the debt miracle. So often what happens when you start the Smith Manoeuvre, we take various debts that you may have, and roll them all into the mortgage, especially this higher interest rate or that's a really high payment or something. but you get the readvanceable mortgage, roll your other debts into it if you can, the ones that makes sense to get rid of. And then what you do is you take all the payments from the debts that you got rid of and you add them all to your mortgage payment. So I actually had clients that did this a number of years ago. They had a bunch of different debts, car loan and RSP loan and credit lines and credit cards, and they had a bunch of things. And they were adding a mortgage and they were making all these big payments. And the mortgage came due and they had some equity. So we put all the debt into their mortgage and we'd added up everything that they were paying. All of it together, they're paying like $4,000 a month. We made that their new mortgage payment. And now they're paying a huge amount of principal, which means it was a really effective Smith maneuver. And the funny thing is, so the reason we call it the debt miracle is before this, they had tons of debt and they were not able to save anything. They're just making debt payments all the time. And now they're making the same total payment, but they're actually investing $2,000 a month from their credit line. And everything is financed at a lower interest rate, and they got some tax deductions out of it. It's like a total miracle just to be able to do this. The sixth version is the Smith maneuver with dividends. It's not one that we do. I've seen some people that do it. It's, it's kind of, you get these dividend investors that do it, and people that think you have to have a dividend to make it tax deductible. But, it's not very efficient. So I've actually modeled it. And generally, because you're getting the dividends, you're getting smaller tax refunds or maybe none. So then you generally need to earn about a 1% per year higher rate of return than you would if you had more tax efficient investments. I also have a cool video out called Dividend Investing is a Brain Fart. So for those that think dividends are actually a good benefit, there's really a dividend is exactly the same thing as selling some investments. So it's, and listen to that video if you doubt me on that. The seventh one called the Smith-Snyder, and this one has a tax problem. There's people that have been marketing this. In fact, marketing this like 15 years ago, it was a really big thing. In fact, there was a few large firms that were marketing this where you borrow a bunch of money and you buy mutual funds called T8, which means they pay out 8% of their balance every year. And some of them were paying actually quite a bit more, like 13 or 15%. So they're paying a large amount out and they were using that to pay down the mortgage. The problem is that much of what they were taking out was return of capital. It wasn't actually a gain. It wasn't growth. It was just giving you your own money back. So that meant part of the mortgage is not deductible. So you end up with this tax problem on it. All right. So it wasn't really a good strategy. But where it does come into effect is you do the Smith maneuver. And then once you retire, now what happens is you want to take cash flow out of these investments. And this is kind of what you do. You decide on an amount to take out. And you might be taking out part of the principal by doing it. But so then you got to do a math calculation to find, is it still all tax deductible? We've got a big spreadsheet that we do for clients to track, is it still actually tax deductible? But that is generally how you take the Smith maneuver and give yourself retirement in, cash flow after you retire. The last one's called the Rempel maximum. I named it myself. Basically, it's the maximum growth strategy. And what it is, it's the maximum you can borrow to invest without increasing your cash flow. It's basically all it is. So it's more a concept than an actual thing. But just think of it, instead of, you're paying down $1,000 a month of principal on your mortgage, you got $1,000 a month available on credit lines. So you're investing $1,000 a month. But instead of doing that, you think, okay, well, how much of a loan? I can go and get a $300,000 or $400,000 loan, and my interest payment is $1,000 a month. So you go out and get that large amount, and that's covering the payments. So that's, it's a way to just really to grow at maximum. So that's not for everybody, but for people that really want to grow their net worth, this can be a really cool strategy. Now, so why is it critical that it's a long-term strategy? And basically is you want a very high likelihood of a good result. So if you do it over the long term, you have a very high chance that it's going to work really well for you. So, and the reason for it is because you're mostly investing in the stock market, and the stock market's pretty unpredictable short term and even medium term, but it's much more reliable than people think as a long-term investment. When I say long-term, I'm talking about 20 years or more. And so the stock market, believe it or not, is actually more predictable after inflation than bonds after 20 years. So bonds often get killed by inflation, but stocks have tended to generate, to stay ahead of inflation over long periods of time. And I've got a chart here that actually shows you how the risk for stocks measured by standard deviation is, of course, higher than bonds and cash for 1, 3, and 5, and 10 years. But once you get out to 20, and this is numbers after inflation, once you get to 20 years, it's actually a lower standard deviation, which is the common measure of risk. So that shows you how this is a reliable strategy, investing in stock market or equity kind of investments over the long term. And it tends to work as long as you can really stick to it long term and, and invest, in a good method, well diversified method. So, basically, stock market is the highest return asset class, quite reliable long term. And, if you study the market history, that you'll see that. And basically, after 25 years, the market has been, based on history, between 7 and 17 times higher. And that's what, when you think of it now, I'm putting a bunch of money in 25 years, it's going to be between 7 and 17 times what it is now. And that is how you retire comfortably and have the future you want, So basically, the stock market is the most effective retirement investment for most people, and that's why it's used. So, I have a couple of charts I can show you briefly that shows, the market over one year is very all over the place, 25 years, very consistent. And, the standard deviation over a long time is slower. And people say, why does the stock market keep going up? And the reason is because when you track the profits of the underlying companies in the stock market, they rise at roughly the same rates. And that's why it goes up. So that's why it goes up over time. So what is the right mindset to minimize the risk and maximize your benefits? The right mindset is to be able to think long-term and be confident about it. So the risks are real. You can minimize them. In fact, really make them very low, but the risks are real. So borrowing to invest is risky. It magnifies the gains and losses. You've got to pay the loan regardless of what the investments do. So, and if you're the kind of person that might panic and sell anytime in the future, just because your investments are down, then, it's a bad idea. So those are real risks. And so the Smith Maneuver is not for everyone. Okay. But the way to minimize risk and maximize the benefit is, first of all, make a commitment that's at least 20 years. Be a long-term thinker. It can't be this 1 year trial. You need investments that you're confident in. So, we have a portfolio manager that finds these world's top investors for us. That's confident. We're confident in it. Some people buy broad indexes because they can be confident of it. But you need an investment that you're confident in. And the reason is because when your investment falls, not if, but when, it falls 30%, you got to stick to it. And if you're not confident in it, then this whole thing could really be a bad thing for you. So you want to invest tax efficiently, which means you need the right tax efficient investments. And generally means you buy and hold, long term, so they don't trigger a lot of capital gains. So you got to be able to stay invested through the down market. And we actually call this lifeboat drills. And actually we go through this with clients. We say, okay, when your investments are down 30%, what are you going to do? And how are you going to feel? So, you're starting off, you're borrowing to invest $500,000. Okay, let's say a year from now it's a bad year and you're at $350,000. How are you going to feel? And what are you going to do? So the truth is, that's a great buying opportunity. It's not a time to panic and sell. Okay, but you got to think of it ahead of time, because then when it actually happens, you think, this is what we talked about. We talked about it with, it's going to fall 30%, and it has. Okay, so I know what I'm going to do. I'm going to stick with it. So. And a really big thing is you have the confidence to invest during a bear market. We had a client that actually, we wrote a plan for him, and he was going to do a large investment loan, which he hadn't done before, and he felt good about doing it. But it was, this was like just after 2008. The market at that point was down over 40% from where it was 6 months earlier. And all the news was bad. It just looked horrible. And I was telling him, you're getting in 40% less than it was a little while ago. And it's a good long-term thing. So it still makes sense to do it. And thing is, he had the courage to be able to do it, to put it in. And all the news was bad. And as it turned out, he put it in March 9th of 2009. The market bottomed the next day at March 10th, and then it took off from there for an 11-year bull market. So now part of that was luck, but part of it was also having the confidence to invest when it's down. Like a lot of people say, I'm going to wait until the market stabilizes. Well, when it stabilizes, it's 20 or 30% higher, and you just missed all that. So buying during a panic time, buy when there's panic in the streets. That's the kind of thing that actually works. Is you have to have confidence to be able to do that. So So the concept of the Smith Maneuver, it's a different way of thinking. Like a lot of people think, oh, I'm going to eventually pay off the house and then have no payment. But that doesn't happen with the Smith Maneuver. You always have debt. So it's you're borrowing and getting a bunch of investments that didn't come out of your cash flow. But once the mortgage is gone, you've fully replaced it by a credit line, which you make it into a new mortgage, but not all tax deductible now. But you still always have debt. Okay, so it's a different way of thinking. But now you've also got a ton of investments, and that's how you live well. So investments are only to provide you for the retirement lifestyle. That's what all these investments, that's what they're for. So risk tolerance is the big thing here. It is a learned skill, and it's similar to turbulence tolerance when you're flying. So basically, if you've been on a bunch of flights, you get used to turbulence now and then. You realize it's going to happen and you'll be fine. The worst thing you could do is get off. That'd be a horrible idea. And that even though there's turbulence, that flying is still the fastest and most reliable way to get to your destination. So that's why you fly. And borrowing to invest is, and even investing more aggressively that in the stock market, that's risk tolerance for you. The biggest way to have the right mindset is make it part of your financial plan. A financial plan, it's what you want in the future. Now you know exactly what you have to do. And because it's part of it, it keeps you focused on the long term, and you don't get caught up in, I should do something different this year, or, let's try something totally different. You stay focused on it for the long time. And, your financial plan is the GPS for your life. If you've tried driving somewhere where you don't know without a GPS, it's tough. But with a GPS, you know exactly where you're going, you know exactly how to optimize to get there, and you get this confidence. And that's the difference that a financial plan does. And when you have that, and you know that the Smith Maneuver is part of it, that's what really gets you there. And another thing that just helps you be confident with the whole strategy is to work with experts. So, experts can help you stay focused and give you confidence that you're doing everything right and you're not worried about it. So we are the, kind of the leading experts on the Smith Maneuver in Canada. We've done it with more clients, I think, than anybody else. And actually, I'm aware that there's lots of people out there that have, watched my videos and are doing it themselves. So, but I think we've helped a lot of people do it. And, I think we're probably the only source for all 8 Smith Maneuver strategies. I don't know anybody else that even knows what all 8 of them are. But it's also good to work with a tax accountant that has experience working with it and can make sure that everything stays right, and someone's representing with CRA. And it's good to be with a planning practice that combines this strategy into a financial plan. It's not just a quirky strategy you do on the side. It's part of your main financial plan, and that's what makes the difference for it. So now, a big difference, I just want to show you how much difference it will be. We've talked about in other videos about the risk of having really conservative investments. So, if you have a couple age 35, they earn $100,000 each, so $200,000 total. They want to retire at age 65, so 30 years from now on $75,000 each, that's $150,000 of today's dollars money. So it's 30 years, they got 3% inflation. Let's say they get the maximum of all the government benefits. So if they invest, in a balanced portfolio, like everybody says, have a diversified portfolio of stocks and bonds and cash, and then you're getting 5% a year, they actually need to get $6.7 million 30 years from now to buy the equivalent of, have a cash flow, the income equivalent of $150,000 today. So, which means they have to invest $100,000 a year. Now that's ridiculous. They only make $200,000 a year total between them before tax. There's no way they can invest, $100,000 a year. It's 50% of their income. Now, if they invest in equities and you have the risk tolerance, you make 8% a year, then you only need $4.5 million, and you can get there investing $40,000 a year, which is 20% of their gross. Now, basically, that's a little more than maxing their RSP and some TFSA. That's really all it is. So it's it's way less that they have to invest, and it's a difference between a ridiculous amount, and it's not easy to invest $40,000 a year, but if that's kind of a doable thing. Now let's take that same couple and put it on the Smith Maneuver. So instead of just having to invest $40,000 a year, now because they're doing the Smith Maneuver, let's say they have $1 million home and $800,000 mortgage, and they're slowly converting it over 25 years, their magic number is $4.9 million, not 4.5, because they got to pay the mortgage, the tax deductible credit line after they retire. but they only have to invest from their cash flow 20,000 a year, not 40, because the rest is coming from Smith Maneuver. So the Smith Maneuver is giving them another time as much as what they're doing from their cash flow. So they only need to invest 10% of their gross income, like 20,000 out of the 200,000, and the Smith Maneuver, and now they are on track for that retirement that they want. And that's the difference that the Smith Maneuver can make. So my name is Ed Rempel. My blog, Unconventional Wisdom, is #1 blog in Canada for a full-service financial planner. It's just edrempel.com. If you're interested in potentially talking to us, you can just talk to us and see whether or not we are a fit to work together. And so just go to edrempel.com/talk. Blog, podcast, and YouTube. So however you prefer to read, listen, or watch. The podcast is edrempel.com/listen. And the YouTube is edrempel.com/watch. Thanks for listening.
Some very interesting information here. I'm sure a lot of people are going to be calling you about the Smith Maneuver. Ed, thank you so much for joining me at the Canadian Financial Summit this year.
Thanks for having me, Barry.